Hey everybody, Kevin Shortell here with another video blog for you. Many of you probably saw the video blogs that I did with Rick Allen at PaperStack. If you haven't, please go check those out as well, because we talk about the results of what they've seen trading on their trading platform. And I went and dug deeper on the entire industry, specifically looking at non-performing loan inventory, and there's a reason for that. One of the biggest things going on in the news right now this week was a so-called GSE Patch, and how the government-sponsored enterprises have been utilizing that patch, and guess what? It's grown. Is that a problem? Is that not a problem? What even is that? All right, let's go into all of that in this short video blog for you. Well, first of all, the Consumer Financial Protection Bureau in 2013 changed the way loans were done, right? We had a massive crash in the industry, got too loose on policies, so the CFPB came in 2013 rather, they said you have to meet two boxes here. You have to show that people have the ability to repay, and that makes it a qualified mortgage. And the definition of the qualified mortgage really in itself meant that the people had to have a certain standard, because all of that ability to pay has to be proven, right? So they need to see financials. They've done a full due diligence check. So the very definition of qualified mortgage had within it this ability to repay and to be able to show that. Well, the concern became that with these type of loans, are we cutting out certain borrowers, because not everybody could qualify. So for a qualified loan, okay, qualified mortgages under their definition, that meant that that loan is not going to be negative amortizing, it's not going to be interest only, and there's not going to be any balloons. So some of that creative financing that was done pre-crash in the 2000s, they just said we're not doing those sorts of loans anymore and called them qualified. Furthermore, it says no more than 30-year, fully amortized, principal, interest, taxes, and insurance included, with a fixed interest rate for a minimum of the first 5 years. Okay, let me break that down. So they didn't want you to do longer than 30-year loans. That would not be, if they did longer than 30 years, it's not going to be qualified. They want it fully amortized. So again, no non-interest only, that sort of thing, no negative AMs. They wanted it to include the entire payment, principal, interest, taxes, and insurance to be considered qualified. And the interest rate had to be fixed for at least the 5 years. And then it could adjust from there if that were the case. In addition, they said to make it a qualified mortgage, points and fees cannot exceed 3% of the loan amount. Once again, this is why a lot of the big banks don't like to do small property loans. They can't make any money on a $50,000, $60,000 loan. Next, fully verified income and financial resources. So again, the paperwork has to be there. Monthly debt obligations to income cannot exceed 43%. Okay, so all of those were in that definition of 2013 to establish what is a qualified mortgage. And of course, that's important because this was all created so that Fannie Mae and Freddie Mac would be taking on less risk. Fannie Mae and Freddie Mac have to buy these loans. So buying qualified mortgages is really what the CFPB was trying to set up here. However, within all of that, they also created this temporary category known as the GSE Patch. Okay? Now, the GSE Patch was put into place because they figured, what if loans are already in the works right now? And what if people don't have a steady income? Are they going to be cut out of the equation here? So that GSE patch was already targeted to expire 7 years after it was written into the law there, which would be January 10th, 2021. But it could be sooner if the GSEs come out from bankruptcy protection known as conservatorship. Technically, they didn't declare bankruptcy, I get it, but they were under conservatorship. So will these qualifications lock out certain consumers, specifically non-W-2 consumers, which could be self-employed people, it could be retired people, it could be people who work on a contract basis where there's no steady income, they make a lot this month, they don't make anything the following month, etc. So they created this patch that could make exceptions to this qualified mortgage. Now, to update that worked out pretty well. The GSE patch accounted for an estimated $260 billion of 218 home loan originations. So this program has grown. Now, percentage-wise, that's only 16% of loan origination, so small percentage, but it's growing. In fact, it's the fastest growing area of loan originations today. So a couple charts that I've put together on this, and by the way, this is all through CoreLogic. There were 3 sources that I used on this, but these charts are specifically from CoreLogic. On the first one there, they're showing the above 43% debt to income trend. And you can see Fannie Mae has raised the debt to income 45 to 50%. And look at that trajectory there. This program, which is meant to be temporary, which was meant to help a temporary situation, well, guess what? Unintended consequence is more and more people are using these, and the government enterprises here are taking on more inherent risk. VA is a part of this as well. As you can see, much lower numbers on the conventional conforming here. So our government enterprises are taking on more risk, which builds up potential non-performing loan inventory. Because we all know what happened the last time they started doing loans to people who really couldn't afford to make those payments on a steady basis. So here's another one for you. This is the share of purchased mortgage applications with debt to income ratios over 43% by borrower's age. So the biggest groups here are the young people, right, just starting out, and older folks who are retired. Again, not being on W-2 income, they may have investment money, they may have Social Security, those sorts of things coming in. And you can see the group that uses it the least is in their mid-50s, which to me makes sense because in the United States today, still the peak income generation years for most people in the U.S. is in their mid-50s. Okay, so we're starting to see here this affects the age on the low end and the high end equation of these, which can be potentially riskier loans. Number 4 here shows the share of purchase mortgage applications with debt to income ratios over 43% by the borrower's annual income. So incomes heavily using this are lower income. Right? When you start to see that trend line, we could say 105,000 or so, very less frequently that people are using that. In fact, it drops off about $125,000 where 20% of people are even utilizing that, and it goes down from there. But very high end on people making upwards of $100,000, specifically upwards of around $55,000. So people making $55,000 less are much more inclined to use this particular program, which again, if you're investing in the note business, the amount of income people make reflects on the property values that they can make, and that's why this is still the best place to be in the note industry. Figure 5 here, the share of purchase the share of purchase mortgage applications with debt to income ratios over 43%. So these are home prices on the bottom here, and of course, $1 million homes, you're seeing way less than that, under 15% utilize this GSE patch, but the buildup here is upwards to $200,000 homes, and then it starts to spike down from there. So again, depending upon the very loose definition of lower price and homes, certainly 150 falls into that category, and you're seeing once again lower income folks, lower price ranges on the houses taking advantage of this particular patch that is set to expire here. And that's going to be very important to us coming up in the future. So what else is going on? Of course, unintended results. One of the direct results from this program is home prices have gone up, especially in lower price bands. Why? Because more people can qualify on a shorter supply, on a smaller supply. So if you have more people getting these loans because of the patch issue here, where they can qualify with greater than 43% debt to income ratio, they're buying homes. And when they start to buy those homes, the supply goes down, the prices go up. But the backlash is that more people need the patch on all spectrums of income because of housing prices. If the housing prices now go up, the monthly payments are inevitably going to go up on the loan, and people aren't keeping pace with the income level there. Therefore, they need the patch. So it's been feeding itself. If they didn't have this patch in there, the growth would be slower, the appreciation rates would be slower across the United States. It would be a slower recovery. This acted really as a stimulus by saying, well, you can now afford that home even though you don't meet the 43% debt to income ratio. But what happens? House prices go up and more people, regardless of income, start to need that same type of loan. So it's been feeding on itself. Non-qualified mortgages now are the fastest growing segment and could triple last year's securitization issuance. And what that means is this. As this program starts to fade away, and it looks like CFPB is not going to renew this, again, there makes no sense to renew it. The housing market's going to get overheated. Some think it's already there. So this program is likely to expire, and it may not be 2021. It might be before that if they take them out of conservatorship. So the alternative is now the non-qualified mortgages have grown. So people are getting away from the qualified with the patch, moving to non-qualified mortgages. Most of these non-qualified mortgages are not done by banks, they're done by non-banks. That's another reason why you've seen in other videos that I've done that non-banks in the US today do far more loans than banks do today. Banks are getting out of this. In fact, a lot of banks are lending money to the non-qualified lenders out there as far as creating non-qualified loans is what I meant. The non-depositor type of the non-banks, that are doing loans out there. Banks are lending money to the non-banks. Non-banks are taking on more risk by doing these non-qualified loans. But that's where people are starting to go over and get those types of loans. In fact, it could triple last year's issuance. So here's an interesting number just underneath that. The report, and that was by S&P, the report indicates that there have been 20-odd transactions year to date, okay, where there are these securitization transactions year to date totaling over $6 billion, which is already almost double all of 2017 volume. So we're seeing more non-banks, more non-qualified loans, more patch loans under the qualified umbrella, house prices going up. What if something happens to the economy? What if a big hit happens on people's income or unemployment starts to go up a little bit? What's going to happen? Well, these types of loans are going to be the first to go bad. That's exactly what we went through back in the early 2000s. So history here seems to be repeating itself. Unintended consequences, putting the patch in there, fueling the growth, also non-banks entering the picture, taking on more risk, and our government enterprises are buying those types of loans. Non-banks and banks can sell and are selling to a high degree their loans to Fannie Mae and Freddie Mac. And if something goes wrong in the economy, inventory is going to be up in the non-performing loan segment. It's just going to happen. It's not great for the overall economy, but in our business, we see problems, we solve the problems, and we'll look at more inventory coming our way. It's probably not going to be all at once like it was before. As this starts to slow down, inevitably, though, it's going to start to happen because these loans are getting too aggressive in an overheated market. So this has been Kevin Shortell. I hope you enjoyed that short video blog.